Hello everyone, welcome back to Stock Spy. Today we are diving into BigBear.ai's second quarter earnings report, and trust me, this one is a roller coaster. We've got the good, the bad, and yes, the downright ugly. Plus, I'll compare BigBear's growing pain to Palantir's early days and share my take on whether this stock is worth watching. So let's get into it. I'll start with the positives because they do exist. To start with, BigBear.ai ended Q2 with a record $390 million in cash. That's a massive war chest that gives them room to invest, expand, and weather the short-term storms. There is a huge government tailwind. The new One Big Beautiful Bill funnels $170 billion to the Department of Homeland Security and another $150 billion to the Department of Defense. Both areas where BigBear.ai already has contracts and expertise. They have partnered with UAE and rolled out cargo security solution in Panama. These deals shows they are not just betting on US contracts and government, they are going global. They are already there. Comparing with Palantir, when Palantir was in its early growth stages, it also faced a lot of slow adoptions, lumpy sales cycles, and investor doubts. But there is one key difference. Palantir had multi-year high-valued contracts locked in with the US government, intelligence agencies, and the military as well. These weren't one-off deals. They were sticky, renewal-heavy contracts worth hundreds of millions, giving Palantir that predictable revenue and to fund the growth. BigBear's contracts are rather smaller, more project-based, and more vulnerable to delays, meaning they don't have that contract fortress Palantir built early on. Now let's look at the cracks in the armor. Revenue fell to 32.5 million, down from nearly 40 million last year. And that's well below the expectations. Their losses ballooned to 228 million, mostly from non-cash items like re-evaluating deliverables and writing goodwill. But here's a red flag. Management withdrew their adjusted EBITDA guidance for the year. Translating it, that they no longer feel confident predicting their profitability because of ongoing delays, especially on the US Army front. To top it off, the adjusted EBITDA came at a negative 8.5 million, which is worse than last year's loss of 3.7 million. And this is not it. Now let's move on to the ugly part. If this is not bad enough, the major driver behind the stock drop was disruption in key federal contracts, particularly with respect to the US government modernization program. These delays don't just hurt this quarter result, they ripple through the entire year, making revenue unpredictable and shaking investor confidence. As a result, the stock tanked, plunging 23% during the day and nearly 30% after hours trading. Without steady contract flow, BigBear's business model looks really fragile to me. And Wall Street and investors hate these uncertainties and uncertain times. So in the end, here is my take. If you are looking for the next Palantir, BigBear has some of the same ingredients. Yes, government focus, AI-driven analytics, and potential for high-margin data work. Palantir's early success came from locking in large multi-year government contracts that created a steady cash flow. BigBear hasn't reached that level of stability yet. On the other hand, this could be a speculative long-term bet, the kind you size small and keep in the back of your portfolio, knowing it could either 2-3x in a few years or fade away if contract doesn't materialize. For traders, post-earnings drop might create a short-term bounce opportunity. For long-term investors, I would wait for concrete evidence that they can sign and deliver multi-year deals before committing heavily. So that's my breakdown on the Q2 results of BigBear.ai. The good, the bad, and the ugly, and how it stacked up against Palantir's early years. So if you found this video helpful, hit that like button, subscribe for more deep dives. Till next one, bye-bye.